Welcome to the Deep Dive. We cut through the noise of earnings calls to pull out the key insights for you.
That's the plan.
Today, we're jumping into ExxonMobil's recent Q2 2025 earnings results.
Right.
Our mission, like always, is to give you the real story behind the numbers and what management's actually saying.
And this call was interesting. You had strong operational performance.
Yeah, really strong.
But the market reaction was, well, a bit muted, maybe even reserved.
Exactly. So we'll dig into that tension, why the strong results didn't quite translate into market enthusiasm immediately.
And what signals management is sending about where they're headed next.
Okay, let's kick things off with the headline figures. ExxonMobil's Q2, what are the standout numbers you need to know?
So financially, JAP EPS came in at $1.64.
Okay.
That beat the consensus estimate of $1.56. Decent beat there.
Good start. What about revenue?
Revenue was $81.5 billion. Also ahead of the $80.5 billion consensus. Though it's worth pointing out that's down year over year from $93.1 billion in Q2 of 24.
Right. Context matters. And beyond the top line, cash flow. Shareholder returns, always key.
Definitely. Cash flow from operations looked robust, $11.5 billion.
Solid.
And free cash flow, the cash left after their investments, was $5.4 billion.
Okay.
But here's a really big number operationally. Upstream production hit a record. 4.63 million barrels of oil equivalent per day.
A record. Wow.
Yeah. Highest Q2 volume since the Mobil merger back in 1999. That's significant.
Huge. And what about getting cash back to shareholders?
They were pretty generous there, too. $9.2 billion in distributions.
Okay. How did that break down?
It was split. $4.3 billion in dividends and $5 billion in share buybacks.
And they've been buying at those Pioneer shares, right?
They have. They mentioned retiring about 40% of the Pioneer shares already.
Which tightens up the share count, potentially boosts EPS down the line, signals confidence.
Exactly. Shows they think integrating Pioneer is adding real value quickly.
Okay, let's unpack this a bit more. Management commentary always sets the tone. CEO Darren Woods. What were his key messages on strategy, especially that contrast between operations and market reaction?
Well, Woods really leaned into that. He said the quarter, and I quote, "proved the value of our strategy and competitive advantages, delivering for shareholders no matter the market conditions."
So, doubling down on their diversified model, resilience.
Precisely. It's that message of stability. Regardless of oil price swings or market jitters, they're sticking to their plan.
And that plan includes?
They're staying on track with their capital spending guidance. That's $27 to $29 billion for the full year 2025.
Okay.
And they reaffirmed the $20 billion buyback plan for the year as well. It's a signal of confidence in their cash generation.
Let's dive deeper into operations then. Those record production numbers are impressive. Where are the big wins coming from?
A lot of it is coming from what they call their high return advantage assets.
Like Guyana.
Exactly. Guyana is a huge part of the story. They actually just celebrated the 10-year anniversary of the initial discovery there.
10 years already. Wow.
Right. And they have 3 major developments online now, producing around 650,000 gross barrels per day.
And more coming?
Oh, yeah. The 4th one, Yellowtail, that's their biggest FPSO project yet.
Right. The floating production, storage, and offloading vessel. A massive floating factory, basically.
You got it. That's slated for 2026. And looking further out, they see potential for 1.7 million barrels a day, equivalent by 2030, just from Guyana, across 8 developments.
Incredible scale. What about the Permian? That's been another big focus.
Absolutely. Hit another record there, too. 1.66 million oil equivalent barrels per day.
Another record.
And the plan is to grow that significantly, aiming for 2.3 million by 2030.
How are they achieving that kind of growth? Is it just drilling more wells?
It's more than that. Technology is key. They talked about lightweight propant.
Ah, yes. The stuff they pump into wells during fracking to keep cracks open.
Right. And their version, they say, has shown up to 20% improved recoveries in over 100 wells they've tested it on.
20% is a big deal.
It really is. And they're also leveraging their land position, drilling these super long 4-mile laterals.
4 miles, that's huge.
Yeah, much longer than many competitors, and apparently much more capital efficient because of their connected acreage. It suggests they have a maybe more optimistic view on the Permian's long-term potential than some others.
Makes sense. Now, sticking with the Guyana for a second, what's the latest on that arbitration issue with their stake? That's been hanging over things.
Right, the dispute with Chevron over the Hess stake. The CEO, Woods, said the recent ruling was a surprise.
Okay.
But he emphasized they respect the process and, interestingly, said they welcome Chevron to the block.
So accepting the outcome.
Seems like it, but he also really stressed the importance of contractual sanctity for the whole industry. The need to trust contracts when making huge investments.
Understandable. When does that get fully resolved?
They expect it to wrap up by September 2025. But crucially, he said the arbitrator's decision doesn't change anything about their ongoing development plans in Guyana.
So operationally, full steam ahead there.
That was the message. Business as usual on the ground.
Okay, shifting gears. Downstream refining, chemicals, and their low-carbon stuff. What's notable there, are projects starting to contribute?
Yeah, definitely seeing movement.
Right.
Several big projects just started up. There's the Singapore Resid Upgrade,
Okay.
the Folly hydrofiner over in the UK, and the Strathcona Renewable Diesel Facility in Canada.
And these are important because
They're designed to increase production of higher margin products. Converting lower value stuff into more valuable fuels and also tapping into that growing demand for cleaner fuels.
so adding to the bottom line soon.
That's the plan. They're targeting a $3 billion earnings uplift just in 2026 from these projects that are starting up this year in 2025.
$3 billion is substantial.
It is, and it feeds into their bigger ambition. An extra $20 billion in earnings and $30 billion in cash flow growth by 2030. These projects are key building blocks for that.
And on the low-carbon solutions side, carbon capture, hydrogen.
Progress there too.
Yeah.
Their first third-party carbon capture and storage project is actually operational now.
Oh, interesting. Taking other companies' CO2.
Exactly. And they've signed up their 7th customer, bringing the total contracted volume to nearly 10 million metric tons of CO2 per year.
Okay.
Plus, the EPA just issued a draft permit for their big CO2 storage hub in Texas, the Rose facility. They see that as the first of potentially many.
Sounds like a lot of positive momentum. Project execution looks strong. But were there any, flies in the ointment, areas of caution or challenges mentioned?
Yes, there were a couple of points worth noting, particularly around the big Baytown hydrogen project.
Right. The one touted as the world's largest low-carbon hydrogen plant.
That's the one. They're still aiming to meet the deadline for the 45V tax credit.
That's the U.S. incentive for clean hydrogen.
Right. But they sounded cautious about the market for hydrogen developing quickly enough.
Ah. So they might build it, but will anyone buy the hydrogen at the right price?
Basically.
Yeah.
Woods signaled they won't plow ahead with that huge investment without a clear line of sight to a market-driven business. So there's a potential for that timeline to slip if demand doesn't materialize as hoped.
A dose of realism there. Anything else?
They also mentioned other low-carbon ventures like lithium extraction and low-carbon data centers have timelines that are still evolving. It depends on hitting cost targets and, again, seeing real market demand. Discipline seems key.
Okay, now here's where it gets really interesting for a lot of folks. M&A. After that massive Pioneer deal, what's their appetite for more? Are they still hunting?
They definitely addressed that. Management reiterated they do have an appetite for M&A.
Okay.
But, and this is a big but, they have a very specific philosophy, 1 + 1 = 3. Meaning they aren't just buying assets or volume. They're looking for deals across any part of their business where they can bring their unique advantages, technology, scale, integration skills to create value that wasn't there before.
So synergistic deals, not just empire building.
Exactly. They pointed to Pioneer as the model, saying it's already beating the synergy targets they set. They even expect to update those targets upwards later this year.
That's a strong validation of that deal.
It is. But here's the crucial clarification they made. Those ambitious 2030 financial goals, the extra $20 billion earnings, $30 billion cash flow,
Yeah.
those targets are based entirely on their existing organic plans. They do not depend on any future M&A.
Okay. So any future deals are purely opportunistic upside.
That's the message. They're not relying on deals to hit their numbers. They'll only do them if they see that unique 1 + 1 = 3 value.
Interesting distinction. What about costs? With big projects coming online, integrating Pioneer, is the corporate overhead creeping up?
That's a fair question. And yes, corporate costs are increasing.
Okay.
Mostly because of all these new projects starting up in 2025, which adds operational complexity. Also, higher non-cash DD&A.
Depreciation, depletion, amortization, the accounting charge for using up assets.
Right. That's higher because Pioneer is fully in the numbers now, plus overall production growth.
But are they managing it?
They stressed that, yes, they are. They highlighted huge structural cost savings, $13.5 billion since 2019.
$13.5 billion is massive.
It is. And they claim these savings are effectively offsetting the increases elsewhere. They even said their cash operating expenses, if you exclude energy costs and taxes, are actually lower today than in 2019, despite inflation and growth.
Impressive discipline, if true. Did they mention technology like AI helping with costs?
They touched on it. Said their big corporate-wide ERP system and data structure provides a platform for AI. The initial focus seems to be on improving effectiveness, finding efficiencies, freeing up people for higher value work rather than, say, immediate massive cost cuts from AI itself just yet.
Okay, so let's pull this all together for the listener, for you. Strong operational performance, record production, projects coming online, disciplined M&A talk. But as we noted at the start, the market reaction was cautious. The stock actually dipped after the call. What does that tell us?
Right, that's the puzzle. Stock down almost 2% post-call, even with the EPS beat. It really highlights that investor unease we talked about.
What's driving that unease, do you think?
It seems like a mix of things.
Yeah?
Broader macro worries are definitely playing a role. Crude oil prices have been weak, near four-year lows recently. There are ongoing concerns about global trade, potential tariffs impacting demand. And frankly, profits across the whole oil major sector have been down from recent peaks.
So industry headwinds.
Yeah. Plus, maybe some specific concerns about Exxon, perhaps lingering caution around M&A, that deal risk idea after a huge acquisition like Pioneer, and just general uncertainty about where oil prices are headed long term.
So it's that classic tension. Solid company execution running into a nervous external market.
It's exactly internal strength meeting external pressure.
Given that dynamic, what are the key things investors should be watching, the catalysts that could shift sentiment in the coming months?
I think there are four main clusters to keep an eye on.
Okay, number one.
First, that arbitration ruling on Guyana, expected by September 2025. Clarity there, whatever the outcome, removes an uncertainty.
Right.
Second, watch for a volume inflection in Q3. As those new downstream units, the refinery upgrades, renewable diesel fully ramp up, we should see their contribution becoming more visible.
Makes sense. Third catalyst.
Third, capital expenditure execution. Management committed to that $27–29 billion range, even with weaker prices. Delivering on that spending discipline is key for credibility.
Got it. And fourth?
And finally, potential M&A. Keep an ear out for any smaller, bolt-on deals. Management hinted they're looking. Any move there would signal their strategy in action.
So strategically, they're trying to navigate from being seen just as a shale and gas giant.
Right, towards this more integrated lower carbon portfolio, positioning today's wins as proof they can build a more resilient supermajor for the future, aiming for that big 2030 earnings and cash flow boost.
All right, now for our regular This Is Not Financial Advice segment, where we pitch a wild but maybe plausible trade idea. Think hedge fund investment committee brainstorming, purely for entertainment and discussion.
Okay, let's play with that tension we've been discussing. The market's sort of wary of more M&A, right? Despite Exxon saying they only want 1 + 1 to 3 deals.
Yeah.
Especially in the Permian, where they think their tech gives them a unique edge, like doubling recovery with those long laterals.
Okay, so the trade idea.
You could think about a long call spread on a specific, maybe smaller or mid-sized Permian pure play producer, one with really good tier 1 acreage.
A long call spread. That's an options play betting on a moderate rise in the stock price, right? With limited risk and reward.
Exactly. The thesis is this. The market might be discounting the chance Exxon buys another Permian company right now. Maybe they think Pioneer was enough or the timing isn't right. But if Exxon really wants to apply that long ball tech advantage across more high quality rock and wants to build that capital efficient growth way past 2030, buying an undervalued Permian player could make perfect strategic sense. It lets them immediately leverage what they do best.
So the bet is Exxon surprises a cautious market with an accretive Permian deal.
Precisely. You're betting on Exxon's long-term strategic logic potentially outweighing the market's current short-term sentiment, causing that target company's stock to pop. Again, just an idea, not advice.
Okay, let's wrap up this deep dive. ExxonMobil in Q2. Operationally strong, record production, projects moving ahead, a clear M&A philosophy focused on value.
Yep, hitting your marks internally.
But the market response, more cautious, reflecting those broader industry headwinds, some M&A nerves, maybe some skepticism, resulting in that slight share price dip post-call.
It's a clear case of strong micro execution facing macro pressures.
Looking ahead, the company's laser focused on those long-term 2030 goals, big earnings and cash flow growth.
Indeed. Driven by technology, by project execution and disciplined spending. Their ability to keep delivering on that while navigating the energy transition and market swings. That's the key test.
And our crucial reminder: that trade idea segment was purely for information and entertainment. It is absolutely not financial advice. Always, always do your own research.
Please do.
But here's a final thought to leave you with. We're in an energy market defined by this pull between ongoing demand for traditional fuels and the absolute need to decarbonize. Can Exxon's blend of operational muscle in the old world and strategic pivots to the new high-value products, low-carbon solutions, truly put them, as they might say, in a league of their own?
Or will those wider market forces, the macro picture, continue to cap investor excitement, no matter how well they execute quarter to quarter?
Something to think about. We hope this deep dive gave you a clearer perspective on ExxonMobil's latest quarter and the dynamics at play. What stood out to you? Consider how these insights might shape your view of the energy landscape.